So 1031 paper is something I specialize in. I think most all of you are familiar, but I'm going to go over it because there are a couple people who haven't heard it very often. Is the process of taking seller created financing, a seller carry instrument of any kind. And for instance, you folks in New Mexico have a real estate contract. It's a little weird for me how that works, but it could probably be passed through as paper through the 1031 process the same way as a real estate contract. But what we're talking about here is when you do a 1031 exchange, you go from real estate to real estate, okay? When we create paper and go buy with paper, we're really just buying like we would with money. So we're trading seller carry notes, or we're creating notes that necessarily aren't seller carry notes against other real estate, and we're buying with something with it. So I'll start just with giving you some specific examples. So I owned and I probably have a slide for this one as well. I own some cabins up in Woodland Park that I have back on the market now at $950, but I once upon a time had them valued at $750, and I really didn't want to get rid of them. I just wanted to keep them. So but I had $450,000 of hard money debt on them, and I wanted to keep those people getting paid the interest on their hard money, but I didn't want to keep paying it, out of these proceeds. I wanted to get something a little better. So I decided I was going to create a new debt against my property of $600,000 and go just buy something with it. So I went to the marketplace to exchange meetings, like, the kind of thing that we're doing tonight. And I said, hey, everybody, I have a $600,000 first note secured by a bunch of cabins. The rent coming in is twice as much as the payment's going to be on the note. The note's about 80% loan to value, and I'd like to buy something with it. So I now own 11 houses and a duplex in Belleville, Illinois, because I was crazy enough to go to an exchange meeting and say I'd trade that kind of note. So I went and I bought 11 houses and a duplex in Illinois with my $600,000 note, and I moved my $450,000 of debt to the property in Illinois. Okay, so now I still had that $4,500 payment on the $450,000 to deal with, but now it was going to be paid by the $6,000 a month of income in Belleville instead of the $6,000 a month of income in Colorado, and the Colorado was going to have a debt of $3,000 a month instead. Okay, and so cash flow wise, I improved myself, quite a bit just by I refinanced one property, increased its cash flow by $1,500, and acquired another $1,500 of cash flow in the process when I acquired the other property. So,
so Blake,
yeah.
In your example, when you moved your debt, did the hard money lender ask for any kind of title insurance to go on the new property, or like this person sounded like they were very flexible?
Oh yeah, we do everything just like you normally would. So we closed it with a purchase contract with a note and deed of trust as the consideration. We had title insurance. We had a lender's policy on the Colorado property. We had a lender's policy on the Illinois properties. Everything about real estate is still right. I just put some extra wrinkles in them. So we don't reinvent anything. We just are changing the currency. Instead of using dollars, which are Federal Reserve notes, we're using promissory notes that we write. Okay, so instead of a depreciating asset, which is greenbacks, dirty old cash like we talk about, instead of that, we're going to create debt and buy with that. And that's sort of what happens whenever you finance a property. It's just a third party, the bank, comes in and gives the money. And if I try to explain that process to everybody, they'd really think I'm crazy. And that's what everybody does every day. Okay, so they go, when you buy a house, you put 10% down or whatever, and the bank buys a note for 90% of the property value, and gives that money to the seller and allows you to make payments on that note. Happens every day, okay? Now, instead of doing it that way, since we know all these things can be separated, instead of doing that way, we take a property we have and we just create for ourselves that 80% loan to value note, and we go and we buy something with it, okay? Now, the focus of this, I want to be on how the actual logistics of what you do. So I've taught this a lot, and I still have people who I make offers, and I'm just going to make up numbers so I don't use anything that I'm working on. But I make offers to people. Say I offer them $1 million of first notes and deeds of trust secured by Colorado Springs duplexes. So, and again, with a good loan to value or good debt service coverage ratio. So there's a lot of cash flow for the amount of payment I'm making. So I said, I'll give you that kind of paper. 6% interest only paper is usually what I do because the math's so easy. And I'll give you $1 million of that paper for your property. And I'm going to make up something. Say Krishna has a 16 unit in Albuquerque. And I say, I like your 16 unit. I want to give you $1 million of notes and deeds of trust. And Krishna understands paper. So he's, I'm sure, listening and saying, you know what, if for the right 16 units of mine, we may be talking. So I say here, so I'm going to give you $1 million. That's $5,000 of triple net income. I'm going to give you that in exchange for your property. Now, if you have debt on your property, we got to figure out how to deal with that. And that's usually the problem. But what I'm talking now is about is the logistics of it. I make that kind of offer, and my response I get is, and I tell them it can be one note or 4 notes, and however many deeds of trust, because really, at $1 million, I'm going to have 4 duplexes as security for that. Okay, so it's going to be like $1.6 million worth of property securing that $1 million note, just so everybody's safe. And so I'm going to give you that $1 million. It can be 1, 2, 3, or 4 notes. The response I get back is, well, why would I need more notes? And why would I need other collateral besides the property? And by the way, how much is the down payment? And so all of that just tells me that they didn't understand what I was saying at all. Okay, because there's not really a down payment. It's equity in stuff I already own. Okay, so if any of you own anything aside from the house that you live in, so I can use Shirley as an example. She's got some properties down in Corpus Christi that she's going to be working on. And we can go create, easily $500,000 of debt and go buy something with it. And so if anybody would want that paper secured by Shirley instead of what they've got, then we'll want to talk about that. And how that happens is we write a contract just like we always do. And in the contract, as the cash part of it, and I always think of a Colorado contract when we have a real good contract with spreadsheets and the rest of it. But you, in the consideration, it's going to say, here's your price, here's your earnest money, here's $1 million. So the price is $1 million. I put $10,000 earnest money or something. Here's $1 million of paper, and then at the closing, I'm going to get my $10,000 back. Really, it's going to be eaten up in all the crap that it costs to close a deal. But but I'm really just giving you $1 million of paper, okay? And let's pretend you don't have, well, whether you have debt or not. So what you can do is you can take that paper and talk to your CPA. It can be an installment sale, or you can take that paper and move it on to the next deal. But the focus I want to talk about now is it really is just exactly the same kind of transaction that you normally do. So you're gonna, there's the couple of wrinkles is you do a little more due diligence. So I'm gonna go and do due diligence on Krishna's 16 units, do a survey, do an inspection, do all this stuff. I probably won't do an appraisal because I don't know that I really need to. Well, I will. Let's just say I'm going to need to move debt. I'll do an appraisal because I'm going to have a new loan on it. We're going to go through all the steps that we normally would do. Krishna is going to come up to Colorado Springs and he's going to look at all 4 of those duplexes make sure that they are where they are. I'm going to show him comps. I'm going to show him the neighborhoods, everything, so that he's sure that this is stuff that he just prays I would default. Because if I defaulted, he'd get $1.6 million worth of property for his $1 million. So chances are very slim that he's going to not get anything other than the paper. But he needs to come up and look at it and make sure that he believes in it, and he has the same rights to inspect it that I'm going to want on his 16 units down in Albuquerque. And we're going to go through he's going to get title insurance. He's going to get a lender's policy on the duplexes. He's going to know all the title's good, have title work with all the requirements and exceptions and everything, just like you always get. And I'm going to get the same from him down in New Mexico. So everything that we do normally is the same. The only difference is the currency that we're using is not cash. Okay, and so how does it work if you've got debt? Well, okay, so in this case, I have, on that, I probably have, goodness, 600,000 or something of existing debt on those duplexes. And it's all private people that I can move, okay? So I can deliver it free and clear because I have relationships with those people and I can move the debt. If I didn't have that, and if they were all institutional loans, I can still do the deal. I go down to New Mexico and I go borrow 650,000 or 700,000 against the $1 million 16 unit. That $700,000 of money is what's going to pay off my loans to allow me to deliver mine free and clear. If Krishna's is truly not free and clear, he won't just be able to take the paper by itself. We're going to have to figure out a solution because he's going to need to borrow the money against the paper. So it's a little more challenging when he's got debt, and we probably will just change the formula and use a blanket mortgage instead if there's debt on the property. But an alternative would be we would actually, in that case, trade the properties and then do a lease back. So Krishna could go to the bank to move his debt to my duplexes. I'd have the right to buy them back for the $1 million, okay? So I still keep my equity in an option. I have to look at my taxation and make sure I still want to do it if it's that way, because I could potentially, well, I might be able to buy something else with the money. I don't want to get too far afield, but my whole focus here is on, creating paper and buying it. So how do you actually create the paper? You literally get out a piece of paper that says promissory note on it, and you fill in the blanks and you sign it, and you literally take a deed of trust and you fill it out and you sign it. That's here in Colorado where we have a statutory form. Okay, you have an attorney do it if you're in an attorney state, mortgage state, any way you do it. But you then take that to the title company and say, here's my note and deed of trust. At the closing, I'm going to sign this and give it to them, and you're going to do all the notarizing and recording and insuring and everything that you guys always do with it. And here it is. And so instead of a loan package this thick coming from a lender that has all these things for them to sign, they get like half a dozen or maybe 25 sheets of paper from us, and that's your loan documents. And that's what the people. So what happens if I didn't pay? You've got a note and a deed of trust just like a bank would have. So if I miss the payments, following the statutory rules, so you have to miss payments for almost 6 months. You have to be told that you didn't pay and asked to pay and you refused to pay, all the same things that happens with a mortgage. When all those things officially are in default, it's going to go to a public trustee sale. You're going to either get paid off by the highest bidder, or you're going to bid them out of the water, and you're going to take the property. Now the extra money that's bid goes to junior lien holders or back to the borrower. So, we can talk about the details, but it's the same security that the bank has when they're putting a mortgage on your house. So it's got the same gravity, it's got the same personal guarantee, it's got the same first lien position, it's got title insurance. It's got everything just like the normal transaction. So we don't expect anything to be different except from the rules that we normally do, except that instead of giving cash, you're given a note. Okay, and then the implications of that are far reaching, and that's something more than we probably want to go into. But let me know if that's clear with people. And Asher, do you have that creation of wealth thing?
Yes, I do.
Okay, so let me know first of all, any immediate questions about my craziness? And yes, Heather.
So this is exciting to me because I have 5 million in free and clear. So I could take that, write paper on it, and start making offers today.
Absolutely. Now that property in Florida, I don't know the rules. Do you have a public trustee and deeds of trust, or do you have mortgages?
Mortgages.
So you want to partner with an attorney that knows what they're doing, or a mortgage loan originator that really knows what they're doing, because you want somebody to help you on that side of it. Now you're own the property yourself, so you really don't have to. You can use whatever's there, but just CYA and get title insurance, so that everything they help you make sure the paperwork's right. That's really what you're paying them for. Okay, it's sort of.
Tim Mapp, he's my partner in both of the exchange groups we run together. He's a mortgage broker for longer than I've been in the business. So.
Yeah. No, Tim is fine to write the notes for you, and that makes sure that it's done right, because that's the one thing we're lucky in Colorado. The state provides us a standard note and deed of trust, so that's that's what we have there. But yes, if you've got that property, those properties, that's the way to create the debt and keep them. And we'd be happy to sell you stuff. My issue is I'm gonna have to take your paper and trade it up because I got debt I gotta move. So,
right.
But that's the whole 1031 paper process. Okay, so when Heather comes to me and offers me a note and deed of trust and I can't take it because I have debt, I go and try to trade it onto the next property. Okay, and that's actually what we're doing here a little bit, I guess. But let's go back. Will you do just the one that's the creation of wealth formula? The next one. This one. Okay. All right. So but yeah, so any other questions to start with about what I was talking about before? I know to Tiffany, you're probably like, oh my God, this is totally Greek. But I hope you're getting something from some of it. Any questions? Anybody? All righty, I'm going to go over, this is the first formula in most exchange books, okay? This is why I'm always sort of taken aback when people don't really know how it really works, okay? This is called the creation of wealth formula, okay? When I say 250 to 650,000, that's how much real estate you're owning, okay? That's not your equity booming up like that. It's when you drive down the street and you say, I'm really cool, I'm wealthy, I own not just that one on the left, but guess what, I own the one on the right too. Okay, and so the creation of wealth creates wealth over time, but it's not the formula itself that adds any equity. That's what I want to always focus. We don't miraculously create something out of nothing. So you have a house, and say it's a house in Colorado Springs, okay? So this is something we can relate with our local crazy market, okay? Any house in Colorado Springs, 250 is now stupid because you can't buy a house under 350 in Colorado Springs. But we'll say we're just going to be really conservative, and somebody owns a house in Colorado Springs and they owe $100,000 on it, and they're like, oh my goodness, this thing is appreciating like crazy. When they made the slide, it was 250. Now it's worth 350. Okay, it's just killing it. I don't want to get rid of it. I got a tenant in there. They're happy. They're raising their kids. They're paying me rent. I'm thrilled with it. I don't want to get rid of it, but I don't make enough money on it. I want something bigger. I want that thing across the street. There's a fourplex across the street there with the hand swimming around it. The fourplex across the street used to be 400,000. Now it's 750 in Colorado Springs, literally on the market. Just so y'all know, 750 now for not good neighborhood fourplex. of 2-bedroom units. So anyhow, fourplex across the street is valued at 400,000. Okay, and he says, "Man, I want that. That's such a steal, but I don't have $100,000 down." Now I could go to my banker and crank the debt out of the property, but that's kind of a pain. What I'd rather do is I'm just going to create a second note and deed of trust against this rental house. So it's going to be subject to this first lien, but a second note and deed of trust. And I'm going to use that as a down payment on the fourplex. So I'm taking the debt from the one on the left, and I am the new note, and I'm now giving it as a down payment. And the new debt on the fourplex can either be a new loan from a bank, or it can be a seller carry. That is part of the beginning of the 1031 paper process if we did it that way. But the new debt, let's just talk about regular deals. That's a banker. So a banker has somebody who's given $100,000 down payment on a fourplex in Colorado Springs. They don't have a problem getting $100,000 or $300,000 new loan on it. Okay, so that is a way that we get that we acquire the new fourplex. The person with the fourplex, what do they get? They get a $100,000 note that pays them interest and then a balloon, or it amortizes, and they get $300,000 now. And when it comes time to for their note due, we can refinance whichever way we want to do it. But the or we can borrow more money against the fourplex. The note is actually against the house. It's not against the fourplex. So the house can either be refied or sold, or that note can just be amortized off or paid off. And it can be paid off with a refinance from the house, or from a refinance from the fourplex, or from a combination of the two, whichever way you want to get the thing paid off. So that's kind of the key to what we're, the notion of creating debt. So this, like I said, is so you started with 150,000 equity in the house. Okay, you ended up with 150,000 equity, but now you only got 50,000 left in the house, and you've got 100,000 because that note down payment, you don't owe that on the fourplex. You only owe the new debt, the 300,000. So you got 100,000 equity in the fourplex, and you got 50,000 in the house instead of having 150,000 in the house. This is exactly the kind of thing that Heather can do, but she doesn't have the underlying existing debt. She can just create a new note of any size for whatever amount and use it as a down payment and transfer that much equity to her acquisition and keep the original property. And this can be done over and over. Now, the people who are taking the paper, you don't always find everybody who's willing to take the paper. So that's no restriction on it. The other is, and people should, because it's good interest, it's much better than you get in the bank. But if they want to do a 1031, they can pass that through. And what I do with the 1031 process, it'll show how if you do enough deals, that little $100,000 note becomes not very important, and can actually go to fees, or it can be dealt with as it's exchanged through. So the person with the fourplex who doesn't want it anymore, who wants 300,000 cash and a $100,000 note, they may say, "Hey, I don't want the cash in the note because I get taxed. I want to do a 1031." They can take their cash in the note, and now they're bringing 300 cash along with a $100,000 note to the next deal. That's pretty good, and people usually will look at the note because it's coming with $300,000 of cash. So while everybody should recognize notes are worth more than cash because they bear interest and they have better security than the rest, people don't. Okay, cash still really is king. That's the way the world works, because you can buy whatever with it, but it's not right, it doesn't make sense, and you should only take as much cash as you need for things that aren't real estate. They're smarter to take the note, in my opinion, because what happens if there's a default? Well, if the market crashed and the house isn't worth $250, it's not great. But if the market doesn't crash and it continues to go up and they default on that note, the guy can pay off the 100,000 and own that house. And chances are, with the way that I tell this story is, of course, if it's a rental house a guy wants to keep and there's people in there, they're not going to lose that house. They're going to figure out a way to get you paid, And just make sure that that's what it is, and don't do it with somebody you don't trust. You don't want to have to sue somebody to get paid. You know, you make sure that you like them, you trust them, and you know, and like my dad said, you give people that don't give money to people that don't need it. You know, that's the extreme part of it, but you know, you gotta cover your bases. So anyhow, this is something that we all know theoretically if we know any formulas as far as exchangers, and yet when I make these offers, I still run into challenges. So the other challenge I get a lot of time is people want a property that's not really worth paper, which is better than cash, and expect you to just give them paper for it without thinking anything about it. So it has to be something that we really want to buy, like we'd buy with cash, or we're not going to buy it with paper unless we can put land with it too, or you know, we have other sets of benefits. Like the deal when I was talking about with the Woodland Park, those cabins, it was moving expensive debt, made it where, you know, and creating less expensive debt made it where it doesn't really matter as much what I'm buying as with cash as it normally would. So that allowed it, because I had a $1,500 monthly benefit coming if I bought something break even. So by, you know, looking at the whole picture, you can buy with paper without costing as much, but you really aren't going to shop for things. I don't want people to be unrealistic and think that people are going to trade, for instance, income property, you know, first notes on income property for land, unless it's really good land, or it comes with cash, or it comes with income property, it comes with some other reason to do it, because why would you do that? You know, it's giving them cash plus interest. Unless you're a developer, for instance, Paul may say, I'll do that all day long because it's the right piece of land that I want, you know. And if you're going to build something, that's the right answer. So but anyhow, but that's a you know, doing that's what people do all the time. You just borrow money to acquire the land to do the development and sell the project. That's basically buying it with paper. It's just it's of course going back to cash. And would people take paper for that land? Yeah. So if you're going out to buy land and you're bringing paper, you're going to get it and make sure it's something you know, something that you want, because you make payments on it. So, which is another essential part. Everybody has to make all the payments on all the notes all the time, or the whole system breaks down. So this isn't an excuse for somebody to come in and crank money and not make their payments, because they're still a crook if they do that. And that's you know, a problem. There's, you know, a small percentage in every marketplace, and that makes it tough for people when that kind of stuff happens. But you make sure you have all the protections a bank would, make sure you got the title insurance, and you're in a position where if they default, you're going to be better off than if they didn't default. And as long as you can do that, everybody miraculously does what they're supposed to. And you know, it works out well. So anyhow, there's a creation of wealth. Do you want to go and, you know, I can show you the 1031 paper, but I think you probably all listened to me drone long enough, and maybe want to get to talking about trading properties. Do we have any questions?
Mike, I've got a question.
Sure.
The way I'm hearing this, and I'm new at this, I've only been doing this for a few months, is that new note is a secondary position on the house, isn't it?
In this creation of wealth formula, it is. Usually when we buy with paper, we use first position paper. But the creation of wealth formula we've all been using for years is about activating equity that you have, existing equity. And usually the model of it is using a second note on a property, on a smaller property with lots of equity. But yes, absolutely, that's a second note. And so that's the risk. So you want to make sure there's enough debt equity behind the second note, and that the benefits you're getting in selling the property, AKA the 300,000 cash, is also a carrot. You know.
Got it. So okay, so in other words, it would be a secondary position. So if the second note was defaulted on and somebody came back in, the idea is to have enough equity that second note is going to get paid.
Yeah, that it's going to get paid off either through the, you know, foreclosure process, or you're going to go ahead and say, hey, you know, Mr. who didn't pay me on the note, you're going to you're going to deed this over to me and I'm going to pay off your underlying debt.
Got it.
You know, just some way to figure it out, because you have the right to foreclose on them. There is the underlying debt that's going to be hell on them with their credit and the rest, especially if they've been paying that and not paying you.
Yeah.
But knock on wood, that usually, hasn't been the case when we do these. We ask for personal guarantees, and my recommendation, and I don't know who's a big fan of me saying it always, but you get the personal guarantee and you sue on the note, and then you let the foreclosure happen through the process. And that way people tend to pay, because they've got it. You can get the property and get a judgment against somebody. And if they're in real estate, guess what? You're going to get paid, because they got other stuff. So that's a great question, Barbara. And that is actually creating paper that's a first position is actually better, but it does require moving the debt. And then that takes away from the cash.
Okay.
You see what I mean? So the same formula could work, but deliver 100,000 less cash and deliver a $200,000 first note. And maybe that's better. If we're in a good financial position, we prefer the 200,000 first and the 200,000 cash, but in the general audience may prefer the $100,000 note and the risk and the 300,000 cash. Who knows, so that's sort of a choice. But yeah, beware of the laws. Have an attorney in the state where you're doing the lending. Make sure that they look at it and make sure that you can foreclose if they don't pay you, and that you have enough equity. Now, if the markets crash, we're all swimming in the same goo. So that's a whole nother 2008 story. And I think most of us are old enough that we experience that, and we don't want to see that slow motion train wreck again. So anyhow, on that pleasant note, you're right, Barbara, we got to worry about the position of the note and make sure that it's paid. But this is a great way to sell the fourplex. Now, of course, in Colorado Springs at 400,000, that's crazy. That would be 800,000. But the difference might be between getting 800,000 this way and getting 750 the traditional way. And it just depends on your client's desire. And generally, you can get a little bit more if you take paper. And paper is more beneficial than money in the bank because it gives better interest. So, just my experience. So there's your, any other questions? Otherwise, that's the pontificating you got to listen to today. Yes, Heather.
So thank you. This is Heather in Florida. So I'm wondering, when I'm creating the note, the reason I haven't done this is because I had no one to create the note to. So I don't need anyone to create the note to. I can just originate it.
No, yeah,
Without anyone to create it to.
Yeah, and that's exactly the kind of question that points out why I should have tried to be more thorough on what I cover. Yes, the note will be written out to the party to whom the seller wants the note written out to. Okay, that's a kind of a weird answer, but it usually would be the seller. But in a lot of cases, it will be the qualified intermediary of the seller. So the 1031 intermediary will be the name on the note, so that the seller didn't actually take collective receipt of the note. Because if you put the seller's name on it and it gets signed and it's a promissory note, they have been paid. It's taxable, it's due. So you have it go to the qualified intermediary. The qualified intermediary holds it and then gives it to the next person. In this example, though, what I'm talking about here, if there's no qualified intermediary, you're writing it out to Mr. Seller of the $400,000 fourplex is who's going to be the pay to the order of, basically, on the note.
Right.
Okay.
Yeah.
Couldn't Heather put the note in her name and then just assign that note at closing?
Not if she's the borrower. So if it's an LLC or a group, and Heather's the benefit, Heather holds the note, she can then give it. But I don't believe that you can hold your own note and then trade it unless there's not a law against it, I guess. but I haven't.
I mean,
Yeah.
the guy, your name is on the note. That means you're the person responsible to make the payment.
You're
So
the
if
borrower, but it's hard to be the borrower and the lender on the same note. See what I mean? Now I guess you could, but I would just wait till you know who the lender is and then do it. Now, because if you're just making payments to yourself to season a note, that's probably fraud. Okay. So, because, why are you doing that? Now, if you've got two separate entities and one of them holds the debt and one of them holds the title and one of them, and they're different some way or another, then yeah, I think that works fine. But if it's just for accounting purposes for yourself, that probably should be disclosed, because some people, when they buy notes, say, oh, I want a seasoned note. It's been paid on for months and months and months. Well, that's not what I'm talking about. And to me, seasoned on the note is just nonsense. That's, if it's great if somebody made a down payment, and it's a seller carry note, then you probably want seasoning. But these kind of notes doesn't really make sense, okay? Because you don't know who the lender is until you give them the note. And because they're more a beneficiary and a note holder than they are a lender, because they didn't actually give money. They gave consideration. And so that's where they need to talk to their CPA, because there's different ways that it can be treated. And, that's not anything I'm an expert in. So, but anyhow, you absolutely, the lender, the note holder is the seller of the property in that example. And so you don't have to actually have them written up yet. You leave that part blank. And so when you make the offer and they've accepted it, then you go type their name in it and give it to them when you have to give them the seller carry disclosure and give them the documents and show them what they are. So you're going to be writing, they're not really seller carry, but that's on the contract. That's where it'll fit in the category. But when you give them the note that they're getting, they need to be able to see it ahead of time and make sure it says what you say it says and all that kind of stuff. So on our Colorado contract, we fit it under the seller carry deadlines chart, just because that's where we put it, So anyhow, all righty, Chuck, do you have any clarifications on that? Because Chuck is a Colorado guy too, and we have a real benefit of being able to just type them up.
No, I've typed them up and I've sold them and created them and done wraps with them. And so, yeah, it is a very interesting process. I love the note idea.
Right. So if you just want money and you need a loan, you can go create the note and say, I'll put your name in there for it if you give me X amount of dollars in money. And those dollars in money don't have to be the same dollars in money on that face. They can be less, they can be more, the interest rate can be whatever you want. And so that's a better way to borrow money, in my opinion, is to say, hey, I want to borrow money. You say, I want to sell you a note. It's exactly the same thing. You go to a bank with that approach, they like that better. They're buying notes. They're not, they don't want to. When somebody says they want to borrow money, that implies that they need it. Nobody wants to give money to somebody who needs it. So you tell them, no, I want to sell you a note. I'm a rich guy who doesn't need any money, but I want to sell you a note. Oh, by the way, I'm signing the note. That's a little by the way. So anyhow, that's part of my, what I'm telling you about buying with paper. I buy with generally 6% interest only first position notes secured by Colorado Springs real estate and or real estate in other states, generally residential income property, sometimes a little bit of commercial stuff. But, those are the notes that I trade. And if you want to sell your property and take that, I'm glad to do a deal. And if you don't want to keep it, you can always trade it through. So anyhow, there's the rest of my pitch and why you can see it's self-serving that I teach these things and want people to learn what I'm doing.
You could also take Blake's note and go sell it at a discount and get the cash.
And then I usually put a clause in there. I get to buy it back. So I'll buy my notes back for cash. So if what you're really trying to do is sell your property and you want cash and you'll take less cash, then we can go through these motions, or you can just tell me, hey,
I'll
take
take a 15% discount and we'll call it good.
right, and we'll just buy it. So a lot of times the transactions exchanges revert to discount purchases, because when we figure out the benefits that the clients need, sometimes they really have some crazy need for cash that's a real need for cash, and they're sort of masking it. And let's just find the real benefit sought and go from there.
I think you could talk to Steve and Olaski because I think he's got a pool of notes that are bought at a discount that they will sell you. And so it's a very interesting process.
Yeah. Yeah, Steve does that. He has a lot of notes that if you're looking to buy discounted notes, he's got a great source for doing that. And he'll buy your real estate with the notes and allow your seller to be getting a face value on their property when really you're buying it at a discount for cash. Steve specializes in the reverse of what we were just talking about, right, Steve? One of the things you do. Can't hear you. Unmuted.
Yes, except we're not taking possession. We're offering the opportunity to purchase these notes at a discount, and then you can use them to purchase real estate at face value, which it doesn't get recorded. Actually, you can buy mobile home parks, you can buy boats, you can buy anything with them.
Right. Yeah. So that's just a whole nother formula. And these are notes. These are from life insurance companies. They're totally guaranteed things. They're people who like win lotteries and stuff like that. And they'll sell their, when you see the lottery winner, you can take the cash amount or you can take the annuity amount. That's how it's done. And so they're selling those things. You can buy them at a discount similar to what they offer the lottery winner, and then take the payments. And sometimes you can give that to a seller at the real amount of all the payments put together instead of what you paid for it. So that's sort of that's note discounting in a sort of a on steroids kind of note discounting. Normally what we would do is a traditional note like I'm talking about. Somebody would say, hey, it's a 6% note for 2 years. I need to make I want to make an 11% yield. So on a 2-year note, I'll discount it 10%. That's 5% a year plus the 6% interest. I now, by discounting your note, 2-year note by 10%, I got an 11% yield on a 6% note. And so that's a way you can get higher yields for cash. And a lot of times we'll do that. I'll look at that on some of my notes, because what the heck, it's paying a lot of points, but if I don't have a lot of hassle, turns out lenders, when you add up all the fees, it costs more than they say to get an institutional loan. So as long as the costs are similar, I'm happy to give a civilian the interest. So anyhow, so enough about me. Instead of saying, let's talk about me now, let's talk about you guys now. And yeah, thank you, Chuck. He's applauding, not talking about me anymore. Thanks.
No, I'm saying I love to talk about notes and discounting and moving money around so that you can make a better yield and improve your position.
Yeah.
That's what it's all about. It's not about, you can make a lot of money, but just improve your position a little bit through notes or cash flow or an annuity. We would all love to have money coming in every month to buy what we want or pay our bills. That's what life is about. So I find it very interesting. Thanks, Blake.
I appreciate your enthusiasm. And Chuck's been doing this for 50 years and he's still excited.